안녕하세요. Hello, everybody. It's a pleasure to be here today. Thank you so much for the invitation to speak at this tremendous event. Very excited to be here. My name is Niki Ariyasinghe. I lead Chainlink's business in Asia Pacific and Middle East. I've been involved in the blockchain sector, the Bitcoin sector, since 2014, working at multiple companies. And what I want to do today is take you through a little bit of what's happening in terms of that convergence that people and organizations have spoken about for many years now, which is the integration of TradFi with Web3 and how that will change financial infrastructure for the future. Now, firstly, for those of you who may not know what Chainlink is, we essentially do three things. We started our life in DeFi, powering data, bringing crypto pricing on-chain securely and reliably. And even now, we are over 70% of market share in terms of pricing of crypto assets in the DeFi ecosystem. We then expanded to cross-chain and now interact and natively integrate with over 60 blockchains, both public and private. But importantly, what we're doing is also enabling cross-chain connectivity. So enabling the movement of value, of tokens, of messages between public and private blockchains and public blockchains and private blockchains, all sorts of permutations. And then finally, we're also integrating both the on-chain and off-chain worlds. So enabling the interaction of different blockchains with off-chain corporate systems and messaging systems. And we'll go through some of those examples today. So firstly, a little bit of a look into the past. Some of you may know some of this, or some of you may have forgotten this. But if you think about the enterprise blockchain world, the implementation of digital assets and tokenization, or what they were called at the time, the first phase of this really began in 2016 to 2020. And it was really a period of great exuberance, of a lot of optimism and experimentation. And in the market, you saw these types of headlines where blockchain technology was going to change the world, where many significant tier one organizations were starting to move into the blockchain world, where companies that are very popular today had completely different business models. Circle, which is very well known now as a stablecoin provider, in fact, back then was a competitor to Coinbase as a crypto exchange. And then lastly, you had this interesting concept of consortiums, these groups of companies coming together to collaborate on the technology for the betterment of the industry. It could be banks, it could be insurers, it could be shipping companies. But I think the important thing to understand with all of this, when you think about consortiums, is that, for example, for banks, the idea of collaborating between banks, very fierce competitors, both in Korea and in many other markets around the world, that is not a natural state of being for those particular institutions, this idea of collaboration and consortiums. So this was this first period of optimism and experimentation. Then, the dark times, 2020 to 2023, the pullback. You started seeing headlines like blockchain fails to gain traction. You saw projects that had significant amounts of money invested into them, re-architecting financial infrastructure, like clearing and settlement systems at the Australian Stock Exchange, not succeeding at all, and entire hundreds of millions of dollars being written off because those projects failed. And importantly, those consortiums, those groupings of banks, insurance companies, trade finance companies, a whole range of different companies coming together to collaborate, to set up JVs, etc., they failed. The vast majority of them ran out of money or ran into competitive pressures, and they failed. So by this stage, things were not looking promising. But then, 2023, the rise of this concept of tokenization. Now we have this terminology around tokenization being the killer use case. Citibank and many others have projected tokenization to go up into the trillions of dollars. An expansion into real-world assets, beyond just financial assets like bonds and fixed income instruments, but also into real-world assets as well. And then the market to grow by 10, 20, 50x over the next 10, 15 years. Now, the exuberance is back, but importantly, a lot of things have changed in those 10 years or so. Organizations have learnt. Some the hard way, most the hard way, in fact. But organizations have tried, they've failed, they've learnt. And what's important as we look forward to this period of digital assets, of tokenization, of stable coins and tokenized deposits and so on and so forth is we've learned those lessons, but importantly, what are the challenges that still remain as we think about this convergence between decentralized finance, the Web3 world, and traditional finance, and how is financial market infrastructure going to change in the future? So firstly, the scale of the opportunity as we think about it. I find this to be a highly, highly compelling slide because when you think about it, we're really playing in very, very small markets in the big scheme of things. Crypto, the numbers obviously vary depending on the state of the market. Crypto is several trillion. Tokenized RWA is a few hundred billion. DeFi is similar. But ultimately, when you think about the broader financial system, you think about debt markets, global currencies, the stock market, real estate, derivatives, and so on and so forth, the opportunity is significant. But ultimately, there are still significant challenges that need to be overcome in order for us to unlock and truly scale into those broader markets. So at Chainlink, our view from a technology perspective, now of course there are many other aspects with regards to regulation and legal compliance, which I won't comment on. But when we think about integrating TradFi and Web3, from a technology perspective, there are ultimately three key challenges that really need to be solved for. One is on-chain connectivity, that connectivity between different chains. Second is off-chain connectivity, this connection between the on-chain world and off-chain systems. It often gets overlooked, but we think is critical for unlocking some of these significant markets. And the last component is compliance and how you enable compliance to be done both on and off-chain in this digital asset and tokenized world. So let's start with on-chain connectivity. Quite often with blockchains, with digital assets, there's a lot of terminology, there's a lot of jargon, and there's a lot of hype. And we think that some of the simplistic ideas, the simple ideas, are also some of the most powerful ones, and also some of the most key problems that need to be solved for. So one of the key aspects that you need to be thinking about is ultimately blockchains cannot talk to other blockchains. They cannot interact. Bitcoin cannot talk to Ethereum, those various networks, and so on and so forth, throughout the many, many hundreds of blockchains that are out there. And when you think about it from a traditional finance sense, this is a highly confusing world where there's many, many chains out there. The popularity of those chains change over time. Some chains break down or run out of money, what have you. So ultimately, what needs to happen to drive this connection? I wanted to tell you this story through examples, real-life examples. So this is some of the work we've been doing with two financial institutions in Asia. ANZ Bank, which is the third largest bank in Australia, and ADDX, which is a digital asset platform owned by the Singaporean Exchange and a grouping of other financial institutions in both Singapore and in South Korea. Now, what these institutions were trying to do is to enable a true on-chain financial transaction, what we call a delivery versus payment transaction, where you had the delivery of a tokenized asset. In this case, a tokenized asset is tokenized commercial paper. Commercial paper is a type of fixed income instrument, short term. That instrument is being exchanged in exchange for payment, and the payment is happening via a stable coin, in this case an Australian dollar stable coin issued by ANZ. So the key thing, and I mentioned earlier, the simplistic notions and the problems that we need to solve here. What's happened here though is ADDX has built its digital asset platform on one blockchain. It's a private Ethereum instance. And ANZ has issued its own stablecoin on a completely different blockchain. So these two blockchains do not talk to each other. And so this is the type of problem that Chainlink has set out to solve. And what we have enabled through our offering CCIP, Cross-Chain Interoperability Protocol, is to enable, in this instance, two private blockchains to interact seamlessly. So you have a seamless transaction where you have the transfer of those stablecoins and you have the transfer of the token for that particular tokenized fixed income instrument, commercial paper. The powerful thing here is, if you can solve for this in this particular instance, you can then extrapolate out to many of the other private blockchains that are out there, to many of the other public blockchains that are out there. And then suddenly, you can enable these types of regulated financial institutions in Australia, in Singapore, but in many other jurisdictions as well, to interact, to fundamentally start undertaking transactions together. Importantly, because they're business counterparties and the technology is no longer an impediment in this type of Web3 world. Another example, work we were doing in a completely different context. So this is a transaction that happened between Hong Kong and Brazil. And this is more about commodities and tokenized commodities, with tokenized soybean contracts. And this is reflecting real transactions where, as you can imagine, between Brazil and Hong Kong and Greater China, there is a significant proportion of commodities and agriculture products that are being transacted on. But how do you improve the financial transaction set that's happening here? So in this particular instance, again, you had the issuance of a wholesale CBDC on the Brazilian side. You had the tokenization happening in Hong Kong. And then importantly, you had also two commercial banks, Bank Inter and Standard Chartered as well. But again, these different platforms are being built on completely different infrastructure, different blockchains. And again, where we fit in is that you enable this transaction to occur seamlessly between two blockchains that don't currently talk to each other. And again, you can extrapolate out, in this instance, in the commodity space, in the agricultural product space, that you can suddenly unlock these types of transactions. When we think about cross-chain as well, in more core financial market infrastructure, I also wanted to highlight how the market is changing. So over many years, particularly tier 1 and tier 2 financial institutions around the world have tended to focus on private blockchains, controlled blockchains. And they actually haven't wanted to interact with public blockchains at all. And in fact, JP Morgan, or Kinexys, has been the global leader in this particular type of field, partly because of their size and partly because of the technology investment. But what's exciting was, for the very first time, early last year in 2025, JP Morgan Kinexys undertook its first transaction with a non-fully private blockchain, so a public permissioned blockchain with Ondo Chain. And this was the transaction where it involved the issuance of, or the transfer and purchase of a tokenized US Treasury instrument in exchange for payment on the JP Morgan side. But the exciting part here is, if conservative financial institutions of this size will now start interacting with public blockchains, that starts to unlock a lot of this convergence that we've been talking about in the media and in various markets regarding this connectivity between public and private blockchains. What this means is that the world is no longer going to be fully private anymore. That convergence is going to accelerate. So the second key challenge that needs to be surmounted is around off-chain connectivity, and this is vastly underappreciated. So just like in the previous instance where you had JP Morgan and Ondo connecting via Chainlink, what we also want to do is, from a Chainlink perspective, is to connect blockchains with off-chain systems. So these could be corporate technology systems, these could be messaging systems like Swift, and many others. But again, a few examples. So what we wanted to do in this particular project is to work with Swift, UBS Asset Management, to enable one particular thing. Now, you would have read significantly about the growth of tokenized funds, or tokenization of funds, and in particular, the tokenization of money market funds. So UBS, with their UMint product, has been expanding into this particular segment. And importantly, what we wanted to do was to enable investors into these types of tokenized money market funds to potentially use their current payment rails. Quite often in the blockchain world, and particularly with the focus on stablecoins, there's always an inherent assumption that the investor, that the user, that the company or organization or corporate that's interacting must come immediately on chain. Everything has to be on chain. So that may happen in the coming years and the coming decades. But ultimately, we also need to interact with organizations, with users as they are. And right now, our firm view is that many organizations, many users want to use their current payment rails. So in this particular instance, what's happening is something very unique. Beneath that red box, the bottom half of the slide, that's all on chain. That's ultimately the connectivity into and out of this tokenized money market fund that has been issued by UBS, called UMint on public Ethereum. But what's happening on top is that if investors, in this particular instance, want to subscribe and redeem into and out of their fund, they can do so via Swift. But importantly, what Chainlink is doing is creating what we call hybrid transactions. What that means is the bottom half is on-chain, the top half in the red box is off-chain. And what we've built is a technology infrastructure that still allows a fully automated transaction. So yes, the Swift payment will take some time, but there's no manual inputs required. There's no person waiting there for a key or an email or whatever it may be required. That is a fully automated process. And what we think is this type of transaction model, this hybrid transaction model where parts of the workflow are on-chain, parts of the workflow are off-chain. This is what is going to unlock significant corporates, banks, other financial institutions to come on-chain. Because ultimately doing this, they can do so in a phased way rather than dealing with the expectation that they automatically have to be entirely on-chain. So we believe that this is really going to drive that growth in these types of tokenization markets significantly. The final component I wanted to come to is compliance, a bit of a dry subject. But there's one really, really important reason from a market and a business perspective why compliance is critical for tokenized markets, is that there are significant financial institutions out there that even if they want to enter tokenized markets, even if they want to issue a particular type of tokenized cash, or if they want to buy particular types of tokenized fixed income instruments or tokenized real world assets, they can't due to their legal, regulatory, and compliance obligations. So our firm view is we need to enable these types of highly regulated financial institutions to fulfill those legal, regulatory, and compliance obligations whilst still interacting on-chain with tokenized assets. So how do we do this? So what we launched last year was an offering called the Automated Compliance Engine. And the way to think about it is, if you're transacting, it could be a stablecoin payment between person A and person B. It could be a delivery versus payment transaction where an asset is being transferred and a payment is being made. It doesn't matter. There's really two areas that ACE, the Automated Compliance Engine, really plays a key role, which is it allows organizations to A, fulfill their AML and KYC requirements, and B, impose particular rules or policies around how the transaction will be governed. And importantly, and most critically, if you use ACE, what that means is if you're a regulated financial institution and those particular AML KYC requirements or other policies are not fulfilled, the transaction does not go through. Now that is deliberate, because if the transaction went through and the AML KYC check wasn't completed, then that organization would be liable with its regulator. So this is really about enabling regulated financial organizations to be able to fulfill those requirements and interact on-chain. And so to make this real for everybody, here's another example where we worked with Fidelity International and ANZ out of Australia. And what we're doing here was Fidelity International issued a tokenized fund out of Hong Kong. They wanted to enable a new class of investor to be able to invest into that particular fund. And these were Australian investors paying in Australian dollar stablecoins that were swapped into e-Hong Kong dollars issued by the Hong Kong Monetary Authority, which was then used to subscribe and redeem into and out of the particular tokenized fund. Now, the reason why this is powerful, beyond the fact that it's cross-chain and there's many technical aspects that it's very significant and innovative for, but it's that box at the bottom there, which is the red box. And the last piece of this particular process, after the transaction had gone through, is that the identity information from the Fidelity International was sent back to ANZ. And the reason why this is important is that ANZ has reporting requirements to its regulators. Now, if this couldn't be done as part of this type of efficient process, then it becomes a complicating factor and then potentially starts to violate some of its reporting obligations. So regardless of the circumstance, what this illustrates is that you can undertake on-chain transactions and you can fulfill your compliance requirements. For a regulated financial institution, that is a significant opportunity, and that can unlock capital. So we started this discussion talking about TradFi and Web3. Where is this going? So I spent a lot of time talking about how traditional financial institutions, banks, asset managers, and FMIs can start to come on-chain. They can solve for many, many key problems. But where this is going, and you'll start to see more and more announcements about this year and the next, is that you have the true convergence that is going to emerge between DeFi and TradFi. And one view is it's actually compliance that's going to unlock this type of capital. So you have many organizations like Abra and many other key leaders that are starting to launch their institutional DeFi layer. Abra is called Abra Horizon. Now, beyond just the technical aspects of a large financial institution wanting to interact with that particular DeFi venue, is that organization, if they interact, they need to fulfill their AML KYC requirements. And there are many, many other kind of rules and policies as well. And what the automated compliance engine does is that you can undertake that. So that financial institution knows that when they're interacting with a particular DeFi venue and they need particular data or particular investor information, whatever it is, to fulfill those requirements, that will be done as part of the process. And that then means they can meet their regulatory requirements, and that means they can then start to deploy more and more capital into these types of DeFi venues. Without this, that won't actually happen. So we think this is going to really drive things forward in the convergence of DeFi and TradFi in the next 2 years. So to summarize, thinking back, we started this journey talking about TradFi and DeFi and surmounting particular challenges. But what do these challenges fundamentally unlock from a business perspective? When we think about on-chain connectivity, this is about enabling cross-chain transfers between public blockchains, between private blockchains, any form of permutation. But ultimately what you're doing is enabling organizations to transact more and more. You're expanding distribution for their products. You can issue a fixed income instrument and find more investors. You can tokenize a money market fund and find more investors, etc., etc. Secondly, if you enable these hybrid transactions where you have some components that are off-chain, some components that are on-chain, what you're enabling is a smooth transition for corporates, for large financial institutions to start coming on-chain, not with everything on-chain, but partially on-chain, and they can start to then utilize their current infrastructure and transition over time. This is going to accelerate and smooth this transition for many institutions. And last but not least, the importance of compliance, underappreciated, but absolutely critical in regulated financial markets. And we fundamentally believe that enabling that compliance layer is going to unlock billions, hundreds of billions of capital, which currently cannot be deployed into the Web3 world. So those are some thoughts about where we've come from over the last 10 years or so, some of the challenges that we're facing today. They're not easy to solve for, but we think that they can be solved for. And a little bit of a view of what is coming in the coming year or two. So we're really excited to be part of the South Korean ecosystem. We really enjoy and really excited by working with many of our partners locally, as well as with many of the institutions. And we're super excited to work more closely with Korea to take digital assets forward in the years to come. Thank you very much. Really appreciate your time. 감사합니다.